SPY, VOO, and VBK are three well-known exchange-traded funds, ETFs, from Vanguard and State Street, each offering distinct exposure to the U.S. stock market. Let's break down each ETF and compare them to help you choose the one that fits your investment goals. First, let's talk about SPY, the SPDR S&P 500 ETF Trust. SPY tracks the performance of the S&P 500 index, which includes 500 of the largest companies in the United States. These companies are from various sectors, representing the core of the U.S. economy. SPY is one of the oldest and most liquid ETFs, offering a high level of diversification and stability. It has an expense ratio of 0.09%, which is slightly higher than some other ETFs, but still very reasonable for such broad market exposure. SPY is great for investors seeking exposure to large-cap, stable companies, and is often used as a benchmark for overall market performance. Next up is VOO, the Vanguard S&P 500 ETF. Like SPY, VOO also tracks the S&P 500 index, offering exposure to the same 500 large-cap companies in the U.S. The key difference between SPY and VOO is that VOO has a lower expense ratio of 0.03%. This makes it a slightly more cost-effective option for long-term investors who want to track the S&P 500 without paying higher fees. VOO is perfect for those seeking stability and broad exposure to the U.S. economy through large-cap stocks. Finally, we have VBK, the Vanguard Small Cap Growth ETF. Unlike SPY and VOO, which focus on large-cap stocks, VBK targets small-cap growth stocks, which are companies with smaller market capitalizations but high growth potential. VBK tracks the CRSP US Small Cap Growth Index, which includes stocks of small companies that are expected to grow faster than the broader market. With an expense ratio of 0.07%, VBK is relatively cost-efficient for a small-cap growth ETF. While small-cap stocks offer greater growth potential, they come with more volatility, making VBK a riskier choice than SPY or VOO. Now, let's compare them side by side. First, the focus of each ETF. SPY and VOO focus on large-cap companies from the S&P 500 index, offering stability and diversification. VBK, on the other hand, focuses on small-cap growth stocks, which can be more volatile but offer higher growth potential. Next, the expense ratio. SPY has an expense ratio of 0.09%, VOO has a lower ratio of 0.03%, and VBK has a ratio of 0.07%. If cost is a major factor in your decision, VOO is the most cost-effective option, followed by VBK and SPY. When it comes to risk and return, SPY and VOO offer lower volatility, as large-cap companies tend to be more stable. VBK, however, is more volatile but could provide higher returns over time due to the growth potential of small-cap stocks. If you're looking for stability, SPY or VOO is a safer bet. If you're willing to take on more risk for the potential of higher returns, VBK might be a better choice. In conclusion, each of these ETFs has its strengths. SPY and VOO are both great for broad market exposure with low volatility, but VOO offers a lower expense ratio, making it slightly more cost-effective for long-term investors. VBK is ideal for those looking for growth in the small-cap sector, but be aware of the added risk. The best choice depends on your investment goals, risk tolerance, and time horizon.